If you make $160,000 a year and you're looking at a $500,000 house, this video might save you from making a mistake that takes 10 years to recover from. Because on paper, that income sounds like plenty. Upper middle class, right? You should feel comfortable. You should feel safe. You should feel like buying a $500,000 house is a normal, reasonable adult decision. But when you actually run the numbers the way real life works, not bank math, not realtor math, not you qualify math, real life math, that house can quietly eat almost half of your actual spending money. And that is how people with good incomes end up stressed, broke, and wondering why they feel like they're failing. Let's talk about the number that causes all this damage. 43% DTI, debt to income, which is a fancy way of saying the bank looks at your monthly debt payments and compares them to your gross income. Gross. Before taxes, before insurance, before daycare, before groceries, before any of the things that make you a person instead of a spreadsheet. And if that debt load is under around 43%, the bank says some version of, looks good, you can afford it. But listen carefully, that is not what they're actually saying. They are saying, you meet our approval guidelines. Very different sentence. The bank approved you. That doesn't mean you can afford it. And that difference right there, that's the whole game. Because approved sounds like safe. It sounds like somebody checked the math and made sure you'll still be able to live your life. But they didn't. They checked whether the loan fits inside a formula. That's it. They are not stress testing your actual month. They are not asking what happens when your insurance jumps 22%. They are not asking what happens when your kid needs braces. They are not asking what happens when your car dies 2 months after closing. They are definitely not asking whether you'll still be able to enjoy your life after the payment hits. They're just asking whether you can survive the loan long enough to pay it back. And those are not the same standard. Not even close. So let's do this slowly, like two friends at a table. No banker voice, no industry jargon, just honest math. You make $160,000 a year. That sounds excellent. And to be fair, it is a strong income. Divide that by 12 and you're at about $13,333 a month gross. That's the number people love to throw around. That's the number that makes the house look possible. That's the number that gets weaponized against you. Because the moment someone says, well, your payment is only this % of your income, your first question should be, gross income or actual money I get to keep? Because those are two wildly different lives. Now let's talk take-home pay. At $160,000 a year, depending on your state, your tax situation, your payroll deductions, healthcare, retirement contributions, your actual take-home might land somewhere around $120,000 to $125,000 a year. Maybe a little more, maybe a little less, but we're in that zone. So now instead of $13,333 a month, you're really living on something closer to $10,000 to $10,400 a month. That is your real number. That's your breathing number. That's your life number. Now let's price the house. A $500,000 house is never just the mortgage. That's where people get tricked first. They hear $500,000 home and start looking at principal and interest. But the house doesn't care about your simplified spreadsheet. Real housing payment means mortgage principal, interest, property taxes, homeowner's insurance, maybe mortgage insurance if your down payment is low, maybe an HOA, maybe higher utilities too, because bigger house, bigger bills. So when you add that all up at today's rates, you're not looking at some cute little payment. You're looking at something like $3,500 to $3,800 a month. Let's call it $3,700. That's $44,400 a year. And if anything runs a little high, taxes, insurance, HOA, maintenance, you're effectively flirting with $46,000 a year in housing cost. Now stop right there, because this is the moment the entire illusion falls apart. You do not pay that $46,000 out of your gross income fantasy number. you pay it out of the money that actually hits your checking account. So if your take-home is roughly $120,000 to $125,000 a year and your housing cost is roughly $46,000, you are giving up around 37 to 38% of net pay immediately. And for a lot of families, once you factor in the stuff that comes out before your paycheck even feels usable, retirement contributions you don't want to stop, health premiums, other fixed costs the bank barely respects, the house starts behaving like it's taking closer to 46% of your real spending money. That's the trap. That's the brutal math. 43% of your gross sounds manageable until you remember the government gets paid first. And then insurance gets paid. And then basic life gets paid. And suddenly that affordable house payment feels less like a normal bill and more like a second gravity system inside your life. Everything starts orbiting it. Every decision, every weekend, every emergency, every plan. The house becomes the main character, and you become the supporting cast. Now let's zoom in, because this is the part numbers alone don't capture. Let's say your take-home is about $10,200 a month, and your all-in housing payment is $3,700. Cool, you've got $6,500 left. Sounds fine, right? That's how people talk themselves into it. But now let life walk into the room. Car payment, maybe $500 to $700. Second car, there goes more. Auto insurance, a few hundred. Groceries for a family, easily $800 to $1,200. Utilities, power, water, gas, internet, phones, there's another chunk. Student loans, maybe. Daycare, that one can hit like a truck. Kids' activities, sports, lessons, field trips, birthday gifts, medical copays, subscriptions, gas, home maintenance. And this is the part nobody budgets honestly for when they're emotionally attached to the house. The random, annoying, relentless costs of being alive. The dog gets sick, your tire blows out, the washing machine starts making that sound, your property tax assessment goes up, your homeowner's insurance gets repriced because apparently the sky has decided to become more expensive. And suddenly the entire budget is tight. Not catastrophic, not we're ruined, worse, just tight all the time. And that kind of pressure changes you. You start saying no to little things, then medium things, then things that matter. You stop traveling, you delay replacing stuff, you side-eye every restaurant bill. You feel guilty buying groceries you used to buy without thinking. You tell yourself it's temporary, that you just need to adjust, that once you get a raise, it'll feel better. But deep down you know what happened. You bought a payment that looked fine in a lender spreadsheet and heavy in a real person's life. That's what house poor actually means. It doesn't mean you're dumb. It doesn't mean you're reckless. It doesn't mean you bought marble countertops in a 4-car garage. Sometimes it just means you trusted a system that uses the wrong number. You're not bad with money. You were handed a number that was always going to break you. And that's why this hits people so hard. Because they think, we make good money. Why does this feel impossible? It feels impossible because the math was never designed around peace. It was designed around approval. And I really want to underline this because this is the part people miss. The 43% DTI rule gets presented like a guardrail, like a protection. Like some wise adult in a room said, don't worry, we've made sure you won't overextend yourself. No, it's closer to a ledge, a line that says, technically you can stand here, but nobody mentions you're standing 6 inches from a financial cliff. That's the trick. The bank says you qualify. They do not say you'll be okay. Those are not synonyms. And once you understand that, you stop treating bank approval like a blessing from above. You start treating it like what it is, a maximum, a limit, a number that tells you how far they're willing to let you go, not how far you should go. So what should you do instead? You need a better target, a safer one, a real-life one. A smart rule of thumb is to keep housing around 28% of your gross income. And even better, try to keep it under 30% of your take-home pay if you want room to breathe. Room for repairs, room for setbacks, room for a life that isn't one surprise bill away from panic. Because the goal is not to buy the most house the bank will tolerate. The goal is to buy the house that still lets you be a person after you move in. A house where you can go to dinner sometimes. A house where an emergency doesn't become a credit card event. A house where your budget still has oxygen. That is affordability, not approval. So if you're shopping right now, here's the sentence I want stuck in your head every time someone tells you what you can buy. The bank approved you. That doesn't mean you can afford it. Run the numbers off your real take-home. Not your fantasy salary, not your gross, not the number before taxes took their bite. And if the math makes your stomach drop, good. That feeling is not weakness. That feeling is clarity. That's you seeing through the script. That's you realizing the system was never built to protect your peace. It was built to maximize what you'd agree to carry. And once you understand that, you have something most buyers don't. Perspective, discipline, and the ability to say, no, just because I qualify for this payment doesn't mean I'm volunteering for this life. That's power. That's how you avoid becoming house poor. And honestly, that's how you buy a home without letting it quietly take over your entire future.